أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم. Assalamu alaikum. This lecture is on risk and return. It is a continuation of our lecture on corporate finance for MBA students and our MSc Business Administration student and also MSc Finance. In this lecture, it is divided into 6 parts. It is divided into 6 parts. Now, the first part of the lecture, we are going to be discussing single investment, that is risk and return for a single investment when one make an investment in a single asset. Then the second part will look at portfolio. The third part, portfolio, that is a basket of assets when you have investment in couple 2-3 assets. How do we find the risk and return? Then we'll look at efficient frontier, the risk and return of different investment, those that will give you an efficient return for bearing a certain number of risks. We look at capital asset pricing model, that is the role of beta, that is risk of the market, then security market line, and the concept of alpha and arbitrage pricing model. So, but before we start this first lecture, we want to draw your attention that for every investment there are two objectives. Those two objectives is either you are making an investment to maximize expected return given for a given level of risk. So if you look at this, we have 3 stocks, and out of these 3 stocks, they have different returns. Stock 1 15%, 2 20%, 3 25%. If you look at them, stock 3 has the highest return. Now the 3 stocks have the same risk. So for an objective to maximize expected return, you can see a rational investor will select that has the highest return. The second investment objective is to minimize risk, so for a given level of return. So if we look at this second matrix, we see that we have 3 stocks. The whole 3 have the same returns, then the risks are different. So if it's to minimize risk, then we'll select the investment with the lowest risk, which is the stock with the lowest risk, which is stock 1. So that is a reminder of what an investment objective of most investors are in finance or in whatever we are doing. Now, in investment or dealing with risk and return, there are basic assumptions that we have to keep in mind. One is that almost most investors are risk averse, where they don't like risk. You understand? Then the second thing we should keep in mind is that returns are normally distributed. For a normal distribution, it means if the returns of an investment are normally distributed, it means when we want to measure the expected return, then it is the mean of the mean will now serve as the measure of the return of an investment. Then for measuring risk, we are going to either use variance. For a normally distributed, the variance of the returns or the standard deviation will serve as a measure of return. So these are the 2 assumptions we should keep in mind. So the first part of the lecture, we are going to look at investment when you make investment in single investment. That is the part 1 of the lecture. If you love our video, consider subscribing. Subscribe, hit the notification bell, like the video. The YouTube channel is Data Analytical and Associate. This will enable us to provide enough content for you in the future. Which is risk and return of a single investment. Now, for this, we are going to look at two types of data: historical data. So, if you look at returns in the past, we can decide to look for their risk and return and hoping those return will be replicated in the future. Then we also look at probability data, that is expected return in the future. So we start with historical data. Now, if data of a stock or return in the past are always known, you look at prices of shares. This can be gotten from the stock prices that are published normally every day. These are known, the historical data. So we can compute the return, that is the average return for this measure, by calculating the mean. So if you look at this formula, all you do, you add the returns together. Add the returns together and divide it by how many number they are. So let's take an example and see. Assuming Musa and Salome have shares in Dangote and Bua stock. So over 6 years. Now the rate of return for these 6 years are given in this table. For Dangote, 20.5% in 2015, 2014, 28%, 2013 minus 40.5%. These are the return. This is those for Bua. So we can calculate the return on this by adding this return and divide it by 1, 2, 3, 4, 5, 6 and divide it by 6. So go to the next slide. You can see the solution is we add those returns in our question, 20%, 28%, we add them. So you see the first one plus the second one plus the third one, the sixth, we divide it by 6. This gives us 0.052 divided by 6, and the final answer is 0.0087. So if you multiply it by 100, we have converted it to percent. So 0.87%. For the same thing for Bua. For Bua, we add them all together and divide it by 6, and this amounted to 0.198 or 19.18%. As we know, we can use Excel to compute expected return, historical return, because we use the average function in Excel. So I have just shown how the result will come out. We can see the average is 0.87, which is here. So let's go to our Excel and demonstrate this. So for historical return total, you can see this is the question we asked. Now those are the return. So first we do the sum. So sum is all equal. So we add this. Sum is all equal. So these are the addition of these returns. Then to calculate the average, all we need to do is we take this value equal, this value divide by 6, or say count. You can use count function, count from here to here, enter. So okay, so 0.087 if you want. Then the same thing, all we need to just draw it here. So 0.1980. So if we compare it with what we have done, you can see this is the same value that we have gotten. So alternatively, we can use the average function in Excel equals to average. Average is for mean. Average function, average, you highlight the numbers. These are the numbers, enter. You can see the value is given in percent. So this is it. You can copy it to this side So this is the average function. You can see it's average function of this. So that is how we can use our Excel, the average function in Excel, to calculate this. So if we go back, the next thing we look at is risk, finding the risk of risk of uh, for historical data. We should know that risk is normally in statistics is probability that the return will be less than the expectation. So this variability in return from those expected is the measure of risk. Risk can be measured statistically using variance, standard deviation, or coefficient of variation. So all these measure use deviation of periodic return from the average returns. So if you go further, to calculate variance, our sample variance, what we normally do is we subtract the mean return from each of the return. If we go back, we see these are our returns, and we got our mean to be 0.009. If we go back, let me go back. This is our returns, individual return. This is the mean. This is the mean for Dangote. This is the mean. So we subtract this from each of the returns. So we subtract it from each of the returns and add them together and divide it by n-1 degree of freedom. We are dividing it by n-1 because it is a sample variance. It is a sample variance. And once you can get our variance, to get standard deviation is just the square root of the variance we have gotten. Is the square root of the variance. So if a little note on variance, variance only, you can use variance to know the risk if you are comparing two security. So if you are comparing two security, the one with the highest variance has the highest risk. But mere looking at the variance of one security, you cannot say whether the risk is too high or is too low. So, and because variance is squared. If we go back to our formula, you can see square, 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 square. So the unit of measurement of variance is not, you cannot express it as, you cannot attach any unit of measurement to it. You leave it like that. So, but if you want to impose unit of measurement like the percent, you have to find the standard deviation. So for standard deviation, we say you just take the square root of variance, take the square root of variance. So and it is can be expressed as percent, like I said earlier, and also it is a better measure of risk than the variance. So let's take an example of our Dangote stock, Dangote and Boa stock for Musa and Salome, and see what is the variance and the standard deviation. So we go now, we take each of the return, this we subtract it from, we subtract average from it. This minus this will give us this. This minus this will give us this. That is how we got this. That is for Dangote. So for Bua, this minus this will give us this. This minus this will give us this. So that's how we got this. So this is just the square. This square, you multiply it by itself. That is how we got this. Boa square, that is how we got this. So we just add it. When we add it together, it gives us the numerator in our formula. For Dangote, 0.2975, that is it here. So we divide it by, we have 6 years minus 1. 6 minus 1. So we have 0.5951. 0.5951. Look at the value here. So for Bua, we have 0.3246, which is it, divided by 6 minus 1, you have 0.0649. 0.0649. So that is how we calculate the variance. To get our standard deviation, all we do is we just take the square root of this, the square root of the variance, and we have 0.244. or 24.4%. You can see clearly we did not express the variance in percent, but we express the standard deviation in percent because the value for variance are square, you cannot impose any unit of measurement on it. So the standard deviation for Dangote is 24.4%. That of BOA is 25.5%. So we can see if you go back to our computation of return, which is also there, which is also here anyway, for return, BOA has 19.8%, while it had Dangote have 0.87%. You can see this shows the balance, that the higher the risk, the higher the return. You can see the risk for this is high, so the return also is high. The risk for this is lower than this, the return also is low. This is how we calculate. We can go to our Excel to show you how to do this using the variance and standard deviation function. So historical risk single. So if we come here, we can see clearly that this is our question earlier. Let's assume that this will calculate the variance and standard deviation. So to calculate the variance and standard deviation, all we do is the return minus the mean return. So this is equals to, this is our return minus the mean return for this is this. So F4 to lock it, because we are going to copy it down. We have that. So if we copy it down here, that is the value, and that is the value. This is for Dangote. That is for Dangote. Then square of this, you can see, because I do absolute referencing by locking the mean. So at all points, if you take this and subtract this, so now we square it. This is equals to this one raised to power caret 2. So that is the square. Let's reduce the decimal places. Let's reduce it to 4. I think that is okay. So if we copy it down, we square all. Now we say the summation of that, alt equal, that is the shortcut for summation, enter. This is the addition. So to find the variance, I'm going to find the variance here, equal this divided by 5. We say 6 minus 1, which is 5, enter. So we can see that the variance is the same thing as this. If we reduce the decimal place, you can see they are the same. That is the variance. So here, let me delete it. You can find the standard deviation equals to, you use square root of this number, enter. This is the standard deviation. Let me reduce the point. So 4.39. So if you compare 0.244, so they use the replaces. If I still reduce it, no, not you, I want to reduce. This is what I want to reduce. Let me reduce that. So 0.244, that is the value. So we can repeat this for BOA also. Let me copy and paste here. So for BOA, say equal this minus this, F4 to lock it, enter, copy it down. it down, delete this equals to this square raised to power 2, enter, copy it down. So alt equal to add it. I think something is wrong here. I didn't lock it, did I? Yes, I lock it. This minus, no, it is not sum, it's supposed to be average, enter. So that is the value, and this is the right one. So we have 0.3258 variance. Is it the value? Yes, for 6. So that is the value. Then if we divide it by 5, this divide by 5, enter, we have our standard deviation. Check the standard deviation. The variance 0.0649, that is the value. Then we take the square root. What's the square root? Equals to square root of this number, close, so 0.2547. So you can see the value here, they are the same. So this is how we find directly if we are solving it, but we can use the variance function and the standard deviation function in Excel. So all you do is say equal variance var dot s means sample, dot p means population. So we just highlight the number from here to here, close bracket, enter. You can see the variance, this and this, they are the same. Standard deviation, you can use std equals to stdev dot s function. You highlight the numbers also, enter. That is the value for standard deviation. You can see it clearly here. Let me reduce that. So we can use square root sqrt of the variance to check. You can see they are the same. This is in percent. You can format that, the same thing. So this is the square root, this is the variance. So all you do, you can copy this here. You see that is for BOA, this is for Dangote. So we continue with our lecture. So then another measure of risk is the coefficient of variation. It normally measured risk per unit of return. So a higher coefficient of variation indicates that there is more risk per unit of return. A lower means there is less risk per unit. So for our question, if we compute the coefficient of variation, is simply the standard deviation divided by the mean of return. So if we go back, our standard deviation for Dangote was 0.244. We divide it by the mean of Dangote, which is 0.09 something. So if we divide it, we have 28.15, means for each unit of return, Dangote give us 28.15 risk, more risk. For BOA, if we divide, we have 1.2. So this gives us 1.287 risk for each unit of return. So you can see, using coefficient of variation, BOA has a lower risk than Dangote. So for probability data, assuming we have this scenario, we have boom economy, normal economy, and the probability that we have boom is 30%, normal is 40%, recession is 30%, and these are expected return. Here we are talking about expected return, that is that we may get in the future. When you have this, how to calculate the expected return is you multiply each of these probability by the return. So and sum them together. P times R1, this times this times this times this, you add them together. That is how we calculate expected return for a single investment. So if we want to calculate that, if you look at our data, we multiply this by this, we have 0.060, multiply this by this, we have 0.040, multiply this by this, we have minus 0.015. If we add it, we have 0.0085. This is our expected return. So we can go to our uh, Excel and see how these are computed. So we multiply this. This is equals to this times this. Enter. That is the value. So copy it down. These are the value. So when we add, alt equal to add, enter. So this addition, this is the expected return. This is the expected return. So this is our expected return. So which is the mean of an investment, of a single investment. So the next item we look at is to calculate variance for a probability data. Calculate variance for a probability data, you will subtract each of the expected return from each of the return like we did earlier. Each of this return, this is the expected return, this minus this, this minus this, this minus this. Then you square it, you square it. After squaring it, you now multiply it by the probability. You take this from, it will subtract the return from each of these, we square it, then we multiply it by the probability. When we add them together, that is the variance of using a probability data. So let's demonstrate it. You can see this is our expected return we computed earlier. So 0.3 minus this will give us this value. This minus this will give us this value. This minus this will give us this value. If we square each of these three, we are going to have this value. Then each of these value will multiplied by the respective probability. This times this will give us this. This times this will give us this. This times this will give us this. So once we add all this, the sum 0.0095 is our variance of a single asset. Variance of a single asset. So if we go to our Excel, you see the value. So let's multiply and see. This is equals to this times this to get our expected return first. So copy it down. So alt equal, this is our expected return. So this is equals to each of these return minus the expected return. So I'm going to lock it. F for lock. I've locked it. So I'll copy it down. Now this is, you can see clearly this minus this. You can see also clearly this minus this. So now we square each of these equals to this caret raised to power 2, enter. That is the value. We raise it to power 2, drag it down. that is the value. Then each of these we multiply it by the respective probability. This is equals to this times this. Enter. This is the value. Copy it down. So our variance now is the sum of that. So alt equal, enter. So this is our variance 0.009525. If we check, this is our variance. So to calculate the standard deviation, you just take the square root of the variance. So if we take the square root of variance, we have 0.0976, which is 9.76%. You can see our variance, we have not put any unit of measurement, but for our standard deviation, we have put a unit of measurement. We can express it as percent. So for here, we want to take square root of this value, enter. This is what we got. We express it as percent. I express it as percent, 9.76%. 9.76%. So that is the value for our standard deviation. So to compute the coefficient of variation, we just divide this standard deviation 0.976 divided by the mean we got earlier. The mean we got earlier is 0.085. When we divide it, we have 1.15. That is, for every unit of return, the risk is 1.15. So this is how we do we find our return and risk for a single investment. So in the next lecture, we are going to look at portfolio. That is a basket of asset, how we can find the risk and return of a basket of asset. If you love our video, consider subscribing. Subscribe, hit the notification bell, like the video. The YouTube channel is Data Analytical and Associate. This will enable us to provide enough content for you in the future.